Hello everyone, welcome to BISP Solution. Okay, so today we are going to see under US GAAP Accounting Standard Codification 225 and Accounting Standard Codification 230. So Accounting Standard Codification 225 stands for Income Statement, and Accounting Standard Codification 230 stands for Statement of Cash Flow. So income statement, let's get started with the first Accounting Standard Codification 225. So ASC 225 is a section of Financial Accounting Standard Board Accounting Standard Codification that provides the summary guidance for presentation and disclosure of the information in the income statement under US GAAP. This will include rules on how to report revenues, cost, gains and losses, as well as specific guidance on the items like business interruption insurance and the format of the income statement itself. There are some key aspects of Accounting Standard Codification 225. First is your income statement format. So ASC 225 will address the structure and the components of income statement, including key items such as revenues, cost of goods sold, operating income and net income. Extraordinary and unusual item is the another key aspect. So it include this codification include topic 225-20, which deals with extraordinary and unusual items like that might be reported on the income statement. The next aspect that we will see is discontinued operations. AS 225 also examines subtotals in the income statements that depends on the presence of discontinued operations, which are the parts of the business that are being sold or closed. So income statement is one of the primary financial statement. It is a valuable tool to assess profitability, creditworthiness, investment value of the company. It is helpful in predicting future cash flows based on past performance. Income statement will provide information about company's performance for a specific period. Past performance means the timings, uncertainty of cash flows, revenue statement, for example, gain or loss. Gain or loss from operating sections is available in the income statement. It gives information to the readers about the performance of the company for a particular period. Income statement is presented for the period, not as on date like we generally prepare, like we prepare the balance sheet as on date, but income statement is prepared for the period. Investors can take a decision whether to invest in the company or not by seeing the profitability ratios. So it gives information to the readers about the performance of the company for a particular period. Now we will see reporting, presentation and disclosure of the income statement. So it shows the company's financial performance, including continuing operations, discontinuing operations and the net income after taxes. If we talk about presentation, so income statement has two formats. First is a single step approach, second is a multi-step approach. So income statement has two formats. Now which format to be followed we will see. And third is also comprehensive income statement. We will see these all topics in detail. But we were talking about the unusual or infrequent items. So unusual means it possesses a high degree of abnormality. They are not normal in their occurrence. So unusual items you will see we include here, unusual items. Okay, So I'm talking about that unusual items that which possess a high degree of abnormality. They are not normal in their occurrences. For example, early death, retirement, plant shutdown, and the infrequent items, like they are not reasonably expected to reoccur in the foreseeable future again, like litigation fees, damage caused by natural disaster, write-off of bad debts. So these are all infrequent items. Okay, so as I said, there are two formats, single step and multi-step. So multi-step, it is the most used format. It reports operating revenues and expenses separately from the non-operating expenses. Versus here under single step, this is the easiest format where it will not give you a bifurcation of operating expenses and non-operating expenses. It provides a simple designer format which rules out any irrelevant item of a particular user. So here investors have one demerit, that they do not know how much revenue they earn from operating income or non-operating income. You don't have a bifurcation of operating and non-operating. So you see total expenses or the revenues, incomes, the expenses are getting subtracted from this revenue. So you have all revenues, all the revenues, and then you have followed by all the expenses. When you deduct expenses from the revenue, you will reach till your net profit. Okay, so there is no bifurcation, so it is pretty simple, right? So but investor has one demerit here, because they do not know the relevance of that what they earn from the operating income and non-operating income. So that's a demerit over here in single step format. But generally we follow the multi-step format. In single step, if you see, revenues and other items are there, which shows sales, revenue from sales, revenue from services is 150, revenue, rental revenue is this much, interest revenue, and then gain on sale and other revenue. So this is the total of revenue and other items. Then you have expenses, which shows the cost of goods and services sold. Then you have cost of rental income, selling expenses, general and administrative expenses, depreciation expense, interest expense, loss on assets. So this revenue minus expense will show you the total, the net profit. Okay, so this is how it is followed. But in multi-step, it is the most used format. It reports operating revenues and expenses separately from the non-operating expenses. Now here benefit is enhanced for user information. The detailed presentation assists the user with the readily available data to calculate various analytical ratios at their end, to take well-informed decision about the performance of the company. So here you have income from operations, then you have revenue and gain from non-operations. Okay, similarly for the expenses. Okay, so you see here it is it start with net sales, then you have cost of sales, then you have got gross margin, selling expenses, and then it's an administrative expenses and all. Okay, and then under revenue, if you talk about interest revenue, other revenue, gain on sale, these are the operating nature revenue. And then non-operating nature revenue, it's like this, income from unusual so you have, it's a combination of your operating and non-operating nature revenues and expenses. So again, if you see income before unusual items and tax, here FASB eliminated the concept of extraordinary line items. These items should be reported as a part of income from continuing operations. So initially they were under the head of extraordinary line items, but now they are shown as a part of continuing operations. So this was an amendment from FASB. So earlier we were not showing extraordinary item, but now this is coming under as a part of your unusual items. Okay, so here in the this is a difference that you see here. There is no bifurcation of operating and non-operating. Here under multi-step you get an mix up, like you get a bifurcation of your operating nature income, non-operating nature income, similarly operating nature expenses, non-operating nature expenses. So you see here it starts with net sales, then you have a cost of sales, then you get the gross margin. Okay, sales minus cost of sales, gross margin. Then you have selling expenses, general administrative expenses, general depreciation expenses, then you get the income or loss from operations. So that's why it shows an income and loss from operating nature activity. Then other revenue in case, that is a non-operating nature activity, that is interest revenue, other revenue, gain on sale, because sale is not a part of your operation. Other expenses and losses, that is your interest expense, a loss on sale of assets. Then you have income before unusual items and tax, that is your loss on sale of investment, income before income tax, that is, and then you'll reach till the income tax expense. Okay, so this is how you decide the format of your income statement. Then we have a two the second, as I talked about, there were two formats, single step and multi-step. Then we have here also there is one concept called as gross concept. So gross concept is nothing but it provides information. This is revenue and expenses on the gross basis, that is income received or earned, or you can say expenses and losses incurred during the current period. They all are presented in this section. So this will be presented under revenue and expenses in gross concept. For example, McDonald's is selling burgers and achieving revenues and incurring losses because of selling of burgers and ice creams, soft drinks. That is a relevant expense, because the main objective is to sell, that is your revenue expenditure, because the main objective is to sell the burgers. Okay, so this is your gross concept. And then under your net concept, these are reported as a net proceeds, that minus net book value. So under net concept, you define whatever is your net proceeds minus net book value. We do not show here selling price on net realizable value, but only the net of the income statement, and these are basically due to recognition of an asset, either not in the ordinary course of business or without incurring of the expenses. These are from non-operating section. For example, if McDonald's is selling burger, then its revenue and expenses from operating section will be there. And if we selling furniture, lighting, furniture fixtures, then you are gaining or losses because of, out of that business, that is because of the non-operating nature business, which follow the net concept, that is net proceeds minus net book value is your final amount. Gross concept is followed if you are the main, what is your main core of business, what is the main nature of the business, you are following that, so you follow the gross concept. If you have the operating nature income also, expenses also, and non-operating nature incomes, expenses also, then you follow the net concept. And if you are following the net concept, that means you will follow the multi-step, because here only it will show you operating and non-operating. If you are not following the net concept, if you are following the gross concept, where it will not have a bifurcation of operating net or operating non-operating, then you will follow the single step format. Okay. Okay, then you have comprehensive income statement also. So all those incomes, expenses which are not yet ready to be disclosed under the net income head, they are temporarily parked under the other comprehensive income. So other comprehensive income will be like whatever is your net income, you add the other comprehensive income on that, and then you reach till the comprehensive income. That means whatever is your net income, you add other comprehensive income, then you reach till the comprehensive income. Okay. So if let's see an example how to prepare the statement of comprehensive income. So first you need to give a name of the company for which you are preparing this comprehensive income statement. Then you have to give the name of the statement that you are preparing. So it will be statement of comprehensive income. Then you have to say what is the date. So it will be for the year ended December 31st, maybe 2021. Okay, so it's for the period. Then it will show you what are the revenues. It will show you what are the expenses. Suppose revenue is of $5,000 and expenses is of $1,800, then you will get $3,200 as your income before tax. Okay, now suppose your income tax percentage is 20%. So 20% on it will be 640, and so the net income will be, that is net income after tax will be 2560. So this will be your net income after tax. Okay, so this is how you prepare the income statement. This is how revenue minus expenses, you will get the income before tax, and then when you charge the income tax, you will get the net income after tax. Now we have to show here other comprehensive income. Net of income tax. So like what will be the comprehensive income which is not getting a part of your income statement, like pension net of loss. So you can have like pension net of losses of suppose 1,000. Then you can say unrealized holdings. Unrealized holdings like which are available for sale securities. So these are not actual loss or gains. That's why we do not book it in the income statement. Then you have foreign currency items. Sorry. So like foreign currency items will be the gains or the losses that are arising due to the foreign exchange fluctuations. So maybe it's having a loss, foreign exchange loss. So foreign currency, you can say foreign currency loss because of increase, decrease, or the change in the foreign exchange rates. So other comprehensive income will be it will be 1,000. Okay, so you can add it up. Minus 1,000 plus 4,500 plus 2,500. So that's other comprehensive income is your 1,000. This is your other comprehensive income. So now what will be your comprehensive income? That will be your net income after tax and other comprehensive income. So this is your comprehensive income. That's what I said. Whatever is your net income, you add the other comprehensive income, then a combination of these two you will reach till the comprehensive income. So this is a statement that you need to prepare as a statement of comprehensive income, and you need to present it to the shareholders. Okay, so here like comprehensive income, you say which is not actual gain or actual loss that is arrived. You are assuming that like foreign exchange rate, because of foreign exchange fluctuations, like you purchase the securities and it rises. Like suppose if you purchase a security of 100 rupees maybe 1 month ago, and you have purchased 1,000 shares. Okay, so now it is, the total amount is 1 lakh. Okay, that is 100 into 1000. So that's amounting to 1 lakh. Now it's still you're holding it, but when you are seeing like this, maybe on 1st January 2025. Now if you are checking on 1st February 2025, you found out already, see this is constant because you have not purchased more, you have 1000 shares. You found out that we have purchased at 100. Now the share price have reduced to 50. It has been reduced by 20. Now the share price is 80. So the share capital will be, now it will be 80,000. So you have a loss of 20,000. Okay, this is a 20,000 loss, but this is not actual loss. This you are estimating because of this exchange rates, or because of any reason, any fluctuations in the foreign country. This is the share increase decrease price. Okay, this is not an actual loss. So this loss you will book it in the other comprehensive income. Or maybe your asset revaluation is there, like you have purchased the asset 1 month or 1 year ago, you have purchased the furniture of 50,000. Okay, now the furniture and after depreciation, suppose depreciation of 5,000 has been charged on it, that is 10% depreciation. So now the carrying value of the asset is 45,000. Now you are saying in the market, if I sell it today in the market price is, I am still holding it, I am just seeing the market value. So the market price of it is 40,000. That means you have overcharged in the books. In your books it is, this asset is shown 45,000, but the market price shows 40,000. So you are overcharging your asset in your books of account. So you need to reduce it by 5,000. Okay, and you will say it loss on revaluation or devaluation, anything. So loss on revaluation of asset. Okay, so this is your 5,000 loss. So this is not an actual loss, you're still holding it, you have not sold it in the market. You have just found out what is the real price, or right now what is the market price of that particular asset. So it is 40,000 and you are booking it as 45, although you have incurred a loss of 5,000. So this loss you will show it in the other comprehensive income, because this is not an actual loss. Okay, you are just comparing it with the actual market price. So these kind of losses you have to show it in the other comprehensive income. Okay, so this is one of the statement that we need to prepare. So on foreign currency, like suppose if you are involved in import export trading or into derivative hedging, you have the risk of losing because of currency fluctuation rate falling or shooting up. So any such gain loss which is related to the foreign currency item, you would have to record it in the OCI, that is other comprehensive income. And other comprehensive income will be a total of the net income after tax and the other comprehensive income. So these two total will show you here. Okay, you will get 3560. This is the formula. Okay, so now this was all about accounting standard 225 income statement. We have seen, I'll just quickly revise it. So this was your income statement, how you prepare the income statement, where it shows, see on the left hand you have, this is your income statement where you have to show, this is your ABC Limited, this is for ABC Limited, this is the income statement and the name of the statement, and for the year ending for which period you are trying to prepare. On the left you have, on the top you have like all the revenues, and on the right you have expenses. So first you have interest revenue, then gain on sale, other revenue. So that is your total revenue and other items of 1025. On the right you have selling expenses, general administrative expenses, depreciation expenses. So income and loss from operation and nature of activities 265. So when you this is income or loss from operations, or you can say the total of expenses, and this is the total of revenue. Now you come here, that is, now you have revised to the gross profit. Okay, that is your income minus expenses. Now this is indirect nature expenses. Cost of goods sold, that is 400. Cost of rental income is 75. Selling expenses stand for 155. General administrative expenses 40. These are all the indirect nature expenses. Depreciation expenses of 70. Interest expense of 65. Loss on sale of asset is 30. Loss on sale of investment is 150. Income tax expenses 100. Total expenses and other items is 1065, and the net income from the continuing operation is minus 60. So you see total of revenue was 1025, but the total of expenses it is 1085. So minus 60 is your net income, that is your net loss. Then on the right side you are showing in selling expenses, administrative expenses. So this is getting a bifurcation from your operating activity, non-operating activity. So income and loss from operation, that is your expenses. Then you're showing the other revenue and gains, that is interest revenue, other revenue items, gain on sale, other expenses and losses, that is interest expense, loss on sale of assets, income before unusual items and tax, loss on sale of investments, income before income tax expense 600, and net income from the continuing operation is minus 60. So left and right should get tallied. So this is how you prepare the income statement. And there were we saw that there were two methods, two formats. One was a single step, second was a multi-step. And we also saw the gross concept and net concept, and then the comprehensive income format, statement of comprehensive income. Okay, so this we had to cover in AS accounting standard codification 225. Now the next is accounting standard codification 230, that is statement of cash flow. So in this we'll see how cash flow is a statement is presented, what are the different methods used for it, for the presentation of cash flow, and what are the activities involved, and how important the cash flow statement is. We'll also see how we read the cash flow statement, and we'll also look at some examples. So under cash flow there are some contents that we'll be seeing. We'll see the overview of it, we'll see what are the methods of presentation, what is direct method, what is indirect method, and the format of it. So let's get started with the overview. So yeah, before that, the primary objective of this standard of the preparation of statement of cash flows to provide relevant information about the cash receipts and cash payments of an entity during the period. The information provided in the statement of cash flow, if used with related disclosures and information in the other financial statements, it should help the investors, creditors, and others to do some of the following, like assets. It will assess the entity's ability to generate positive future net cash flows. It will assess the entity's ability to meet its obligation, or its ability to pay dividend, and its meet the external financing. It can now, with the reading the cash flow, the investors can see that they can get the reason for the differences between the net income and the associated cash receipts and payment, and then can also see assess the effect on entity's financial position of both its cash and non-cash investing and financing transactions during that particular period. Okay, so now if you get started with overview. So we here we will be starting with first overview, then we'll see the methods and the activities. Okay, so overview, let's get started. So under overview, the purpose of this statement is to provide information about the sources and the uses of cash and cash equivalent. So sources is like cash receipt, uses like cash disbursement. So cash and cash equivalent means cash is like currency, demand deposits. Cash and cash equivalent is a short-term liquid investment whose maturity is within 3 months, and it will be easily convertible into cash. So in short, we can say that these are the ones which can be easily converted into cash. So if I compare cash flow and balance sheet, so cash flows are the more effective. So now right now, if we compare our cash flow with balance sheet. So, cash flows are more effective in portraying a company's financial position because the balance sheet does not explain why cash increased or decreased. Secondly, cash increasing can be a positive indicator, but it could also be a cause for concern because you are borrowing a lot. Buying plant, property, and equipment which involves cash going out is considered as positive indication. If you're selling a PP, so let's see the cases, like if I'm suppose selling property, plant and equipment. So I'm if I'm selling the property, plant and equipment, so property, plant and equipment is decreasing, right, from the business. If it decreases from the business, that means cash is coming, cash increases, because when I'm selling it, I'll get the cash, so cash will increase. Similarly, if I'm buying property, plant and equipment, that means property, plant and equipment increase, because that will become part of the asset, and cash will decrease because I'll be buying it with, I have to pay the cash, so cash will decrease. So this relation we have to, capture it. If you're selling it or if you are buying it, what will be the relation between them? Now you have, if you talk about the method of it, so there are two methods of preparation of cash flow. First is the direct method, second is indirect method of cash flow. If it's a direct method of cash flow, direct method, here it will not show you, it won't start from the net income. It's a separate for performer, which we have to see. And indirect method of separate performer, although all the three activities are there, will be there. Indirect method, it will show you the cash receipts and the cash payments. In indirect method, it starts with the net income. It add back the deductions that were not allowed, that should not have been done in the income statement. It will reduce the income that was considered as a part of while preparing the P&L. So it will make correction in the net income, and then it will show a bifurcation as per operating, investing and financing activity. So there are two methods. We'll see both the methods. And if we talk about the activities, so there are three activities. That is cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. So these are the three activities that we need to cover. Operating activities will include all the operational nature, inflow and outflow. Investing means where you have invested, if your source or what's your where you have done the investment, from where you have, you know uh, where, like, you're purchasing plant and machinery, you're purchasing of fixed assets, where you have done the investment. And financing is a source of fund. Okay, so that is how you have raised the funds in your business from the share capital, if you have borrowed some money, so long term debt, so likewise. Okay, so this is a source of fund. Okay, so these three activities will be discussed again. So first, it's your cash flow from operating activities. That means we can talk about like receipts and disbursements from transactions reported in the income statement, and the current assets and current liabilities also become a part of your operating activity. Changes in working capital is also shown in the is also shown in the operating activities. Then you have investing activities, like receipts and disbursements from non-current assets. Buying and selling of stock, that is stock trading, also become a part of your investing activity. Then under financing activity, you have receipts and disbursement from debt, equities, like subscription or redemption of equity, treasury stock, that means you are buying back your stock which you have issued in the market. Okay, that's become part of a financing cash activity. Long-term debt will also be shown here under cash flow from financing activity. So here statement presents, that is cash flow statement, it will present the information about material non-cash events which are disclosed separately in the supplemental disclosure. Supplemental disclosure is nothing but a tax and the interest portion. There is no cash transfer in and out, but transaction is just material enough to be disclosed in the supplemental disclosure section. Like if you're converting conversion of bonds to equity, if you are buying the property, plant and equipment by using some stock, if you're exchanging one asset for the another cash asset. So this is the example of a cash flow. Now if I talked about method, so these both will combine. Either if you talk about direct method or indirect method, you have to include all the three activities in it. Okay, so direct method will display a major class of operating cash receipts and disbursement. Non-cash items like depreciation, amortization, they're not disclosed. They'll ignore the gain and loss arising from it too. Okay, in direct method, they won't show you depreciation, amortization, nothing. They'll just display what is operating cash receipts and disbursements. But under the indirect method, the cash receipts and disbursements are not disclosed separately, but adjusted to the net income. They gets adjusted because they start with the net income. We do the adjustments in the net income, so that get adjusted, and they do not become a part in the direct method. Like if we take an example, a reconciliation of like suppose if we talk about non-cash items, so that will be depreciation, amortization. Okay, so they are adjusted to the net income. Reconciliation of net income is provided under a separate schedule. Supplemental disclosure of cash paid for interest and income tax, it is required. I can say if it is a current interest expense, that's a part of your income statement. You can say like if you have decrease in interest payable, so it will lead to a decrease in interest payable, that is it is coming from the balance sheet, so we have to add back in the cash, if we have to add back in the cash statement. Increase in interest payable, that will be reduced from in your cash flow. Okay, so if you talk about direct method of cash flow, let's see the performer. And if you talk about if there's an increase in accounts receivable, suppose accounts receivable, if you talk about in Jan and then Fab, if accounts receivable in Jan was 100, in Fab it got increased to 120, so there's an increase in accounts receivable. That means now you have to decide whether it will be an inflow of cash or an outflow of cash. So if it is an increase, that means you have done more sales and you have to receive more money from the accounts receivable. Okay, so that it means your accounts receivable have increased from 100 to 120. That means a 20 increase, it's will lead to outflow of cash, or you can say cash reduces, cash decreases, because you have still not received money from the receivables. You have done the sale, and you have done the sale on credit, so you have not received the money from them. So that means the money is yet to be received. So you have not, if it is not an inflow, then it is considered to be an outflow. So that's why it's a cash decrease. And similarly, if you could talk about accounts payable, suppose in Jan it was 150 and in Feb it got increased to 170. Again, there's an increase of 20. So whether it will be lead to cash increase or cash decrease, that is cash inflow or cash outflow. So if the accounts payable gets increased from 150 to 170, that means there's an increase of accounts payable. That means we have purchased more. Like if we have purchased more, that means we have paid more, we have purchased more, but we have not purchased on cash, we have purchased on credit. That's why we have our accounts payable standing in the books of accounts. So it will lead to cash increase, because yet we have not paid the money, so it's an inflow of cash. It's the cash is still there in our business, so that's a cash inflow. If the increase in accounts payable, if there's an increase in accounts receivable, so that means there is a cash decrease. Okay, so this is the scenario. Now we'll see the direct method and indirect method. In this way only you have to define the cash flow. So direct method will be, you have to just start with what cash you have received from the customers. So you can say if there's an inflow, so that will be a revenue. So inflow will be like, you're saying you have gained the revenue, so revenue, and you will decrease, you will less decrease in receivables, you will add you will subtract increase in receivables similarly you will less, that is decrease in unearned revenue and you will add increase in unearned revenue. Okay, so if you're doing increase in unearned revenue, that means an inflow. So like I may have debited तो फिर से क्यों बताना है बंद है अभी भी आएगी कि नहीं आएगी Okay, I think there was some disturbance in the voice, or it was not coming proper. So let's start from here again. We have seen that in cash flow, we'll see the we have to cover the three topics. First is the overview, second is the method, third is the activities. So under overview, as I have already discussed the overview of it, overview means what's the purpose of this statement? This purpose of this statement is to provide information about the sources and the uses of cash and cash equivalents. Now sources means cash receipts, uses means cash disbursement. So we here decide what's the source of cash and what is the use of cash. And cash equivalent is like, if cash is like currency, demand deposits. Cash and cash equivalent is like short-term liquid investment. So whose maturity is within 3 months and it is easily convertible into cash. So these are the ones which can be easily converted into cash. So if I compare cash flow and balance sheet, so as I said, if I draw the comparison between cash flow with the balance sheet, so cash flows are more effective in portraying a company's financial position, because the balance sheet does not explain why cash increased or decreased. Okay, cash increasing can be a positive indicator, but it could also be a cause of concern, because you are borrowing a lot. Then buying plant, property and equipment which involves cash going out is considered as a positive indication. Okay. Now if you are selling PP, so we discussed, if you are suppose selling PP, that means your PP is going out from the business, and but your cash is increasing because you have sold it in a cash, so cash increases. If you're buying PP, your PP is increasing, but your cash is going out because you're buying out in the cash. Okay, so this is how you have to tell if you're doing any transaction. You have to recognize whether it will inflow of cash or it will be an outflow of cash. Now if we talk about the second methods, so method, it is like there are two methods. One is the direct method, second is the indirect method of accounting. Indirect method of accounting, you don't show here your depreciations, amortizations here. You directly show what's your cash receipts, what's your cash payment. In indirect method, we always start with the net income. We here adjust the non-cash nature items like depreciation, amortization. We do the adjustment and then we start with cash from operating, investing and financing activity. So we'll see the pro forma. Then you have three activities: cash flow from operating activities, cash flow from investing activities and cash flow from financing activities. Now if it is a cash flow from operating activities, like the cash inflow or outflow which arises because of the operations, because from the operations of the business, that is those inflow outflow we include here under cash flow from operating activities. Cash flow from investing activity means inflow and outflow is arising because of the investment, like you are purchasing the fixed assets, or you are investing in the fixed assets, or you are selling the fixed assets. So that is because of the investing activity, and so that will be use of fund, how you are using your funds to in the investment. Source of fund means that how you are raising your funds from the outsiders, that means from the shareholders, from the, by issuing the shares you are raising the fund, you are borrowing it from the long term funds, from the long term debt. So that is part of a financing activity. So this is your how you are raising the fund. So that is your source of fund, and here it is your use of fund, how you are using your funds in investments. Okay, and this is your operational nature activity, operational nature activities, because that is related to your business. Maybe it is increasing in your inventories, you are paying your accounts receivable, you are paying your accounts payable. So likewise other assets, increase in the cash. So likewise you have to show the operational nature activities. So we took an example, like if there's an increase of interest payable, so we'll add it. If there's a if there's a decrease in interest payable, we'll add it. If there is an increase in the interest payable, we'll reduce it. Now we also took the example of accounts receivable. Here you have Jan and Feb month. In Jan, accounts receivable were 100. In Feb, it got increased to 120. So if the accounts receivable is getting increased, that means there's a differential increase in 20 amounts. If accounts receivable is increasing, so they'll be reducing the cash, because we have made the sales to accounts receivable. We have made the sales on credit, sale done on credit, but we haven't received the cash. So if there is no inflow of cash, so it is deemed as outflow of cash. That's why it's a cash decrease. Similarly, in accounts payable, now we have purchased on credit. That means we have still not paid purchased on credit. That means we haven't paid money to the to our parties, to the creditors. So if you have purchased on credit, that means you haven't paid the cash. So cash is still there in your business. So that means there will be cash inflow. So if it is increasing, that is from 150 to 170, that's an increase in cash. So if it is an increase, so it will be cash inflow. And if the accounts receivable is increasing, so it will be a cash outflow. Okay, so now let's see the direct. These are the three activities. Now if there's a cash increase, decrease, that will all become part of your operating activity. Now we'll see what will come under operating cash flow. So like receipts and disbursements from transactions reported in the income statement, and current assets and current liabilities, or you can say changing in the working capital, will all become part of your operating activity. Then investing activity, receipts and disbursements from non-current assets, buying and selling of stocks, that is stock trading, will all become part of your investing activity. Then next is your financing activity. Receipts and disbursements from debt and equities, subscription or redemption of equity, treasury stock, these all will become part of the financing cash flow. Long-term debt will also be shown over here under financing cash flow. So this statement also presents information about material non-cash events which are disclosed separately in a supplemental disclosure. Now supplemental disclosure is the tax and interest portion. So there is no cash transfer in and out, but the transaction is material enough to be disclosed in supplemental disclosure section. So there were two methods, as I talked, direct method, indirect method. In direct method, here you display major class of operating cash receipts and disbursement. Non-cash items like depreciation, amortization, they are not disclosed here. It ignores the gain and loss too of the non-cash items. And indirect nature, that is cash receipts and disbursements, they are not disclosed separately, but they are adjusted to the net income. Okay, so we were discussing now what's the direct method of cash flow, how we prepare it. So it is like if you have revenue from the parties, you add the receivable, we less, there's a increase in receivable, we'll reduce it. If there's a decrease in receivable, we are adding it. If there's a decrease in unearned income, we are reducing it. If there's an increase in unearned income, we are adding it. So this is how you prepare your direct method of cash flow. Now cash received from customers. Now if you have gain or cash received from, if there's an interest received or a dividend received, sale of trading security, that is your cash increase or decrease. Okay. Now under investing activity, you will have purchase or sale of non-current asset, amount you have lent or repaid the principal, that is your investing activity. So under your investing activity, you can consider, you'll have suppose purchase or sale of non-current assets, and then amounts lent and or repaid. So you can consider it principal only. So this is it will come under a investing activity. Then what will come under the financing activity? You can say issuance or repurchase of own stock, or you can call it you're purchasing your own stock, which is nothing but your treasury stock. Then you are paying the dividend. So dividend paid is also become part of the financing activity, which is not received. You are paying the dividend. Okay. So as far we learned about operating activities for both the direct and indirect method. Direct method involved cash receipts, disbursements, while the indirect method involved net income, adjustment to net income, and the changes in current assets and liabilities. These elements, they make up the operating section of the cash flow statement. So in direct method of cash flow, you are paying the cash to the suppliers. So that is interest paid, income tax paid, or the purchase of trading securities. In direct method of investment, I have shown you that this is how you add up in the revenue. So if you see in the direct method, we'll see what is the net cash provided by operating activity. So only cash receipts, cash payments. Similarly, net cash provided by investing activity, and then net cash provided by financing activity. Here it will tell you net increase or decrease in cash because of it, net increase, decrease, or increase in cash, and then you'll have cash and cash equivalents at beginning of year, and then cash and cash equivalents at end of year. Okay, so this is how you prepare your direct method cash flow, and at the end you will show any supplemental disclosure if it is required. Okay. And indirect income cash flow, it always starts with, I'm just showing you the summary of it. So it starts with the net income. Here we do the additions, that is changes in net income, that is of non-cash nature item incomes we included, like we can call it depreciation, you can call it amortization, and so on. Then you'll have increase or decrease in changes in net assets. Net assets, that means you'll show here if there's an increase in accounts receivable, decrease in accounts receivable, that is changes in the working capital, all the things, changes in inventory, if there's a changes in an increase in inventory. So if there's an increase in inventory, so there will be it will be added, if it is an increase in inventory, it will be reduced because you have a cash outflow, and if there's a reduce in inventory, so it will be addition because you will have an inflow. Similarly, if there's an increase in accounts payable, so it will be add in cash flow. If there is increase in accounts receivable, it will be reduced. Decrease in accounts receivable will show an addition in the cash flow. So this is how you will reach till cash flow from operating activity, and then you have to show cash from investing activity, where you'll say purchase of non-current asset, purchase of property, plant and equipment, sale of property, plant and equipment, these all will come. So here it will show you the sum of it will show you net cash flow, inflow or outflow from investing. Then you'll have cash flow from financing activity, where it will now, this was your use of fund, this is your source of fund, where you have to show how you have raised the fund, like from equity share capital, as equity share capital, or redemption of debentures, okay. So because of it, your equity share capital will increase, your inflow will be there, redemption of debentures, outflow will be there. Here it will be long-term debt, you have raised the money from long-term debt, so that will be increase of your inflow of your cash. If you have paid the dividend, that the outflow of your cash, dividend paid. So in short, you will here see net cash flow from financing activity. Okay, so the sum of all the three activities, that is, this is A, cash flow from investing activities, cash flow from investing, operating, and the cash flow from finance. Sum of these three activities will show you net cash flow from all the three activities. Then you will have opening cash, you will add opening cash, and it should tie up with the closing cash, that means the cash at the year end. Okay, it should tie up with the closing cash. So this is your pro forma that you have to show in the indirect method. Starts with the net income, add changes in the net income, then you will have changes in the net assets, that is the changes in the working capital. The sum total of it you will derive, that is your net income plus changes in net income plus your changes in net asset. All these sum will the sum total of these three activities will show you cash flow from operating activity. Then you have cash flow from investing activity. In that you have purchase of if you are using the funds, that means purchase of property, plant and equipment, you are selling it. Okay, then financing activity will like equity share capital, redemption of debentures, long-term debt, dividend paid. It will show you net cash flow from financing activity. When you add A plus B plus 3, so you will get net cash flow from all the three activities. When you add the cash, it should tie up with the closing cash. This is ultimately your indirect cash flow. Okay, so now we are done with the accounting standard codification. $230 and $225. So we discussed today about the income statement and the statement of cash flows. Yeah, so that's all for today. If you have any questions, please contact BISP Solution. Thank you so much.